So I'm Max Fights, Keller Williams Realtor, here with actually my favorite and preferred lender, Aaron from A+ Mortgage Services. And the reason I made him sit down today on a Friday evening is a lot of us are watching the news right now, and we're reading and hearing more and more about how the people with, I'll arguably say, normal credit scores, anywhere below 780, the imagery and the things that we're hearing is they are being punished for having that medium credit score. So anyone below 780, and correct me when I'm incorrect here, anyone below 780, a lot of the narrative is they're being punished, and the way they're being punished is actually benefiting people with very low credit scores. So one of the things I want to do, and especially when it comes to whenever we're hearing things in the news, is correct the narrative, at least to the point where we're at least being honest about what the numbers in, because obviously it's sensationalism. They want to sell ad space, stuff like that. So I just want to talk to you a little bit about what that actually looks like. So one, there is some truth to the fact that the prime score has changed. And I think it went from what, like 740?
Yes.
Okay.
So first off, we're talking about loans that are through Freddie Mac and Fannie Mae, which is really going to be 90 to 95+% of loans in the residential mortgage world that we're talking about that are impacted by this directly.
Okay.
So a prime score in those loans used to be 740 plus. The prime score did now get moved to 780 plus with some rare exceptions to that. So with that, there is some truth to it, as you mentioned. At 780 plus, you're not going to feel or see the difference. However, if there's a client that's at 740 or 760, there's always been tiers. That has always been the case. The tiers have always typically been 20 points per tier. So from in the past, it was 740 to 720 to 700. And basically the impact of each tier in most scenarios used to be a little bit higher. Now, with two added tiers, the impact is slightly smaller in most scenarios with the tiers. However, there is truthfully now an impact where somebody with a 760 credit score, for example, could potentially be paying a little bit more. Now, where we're seeing this get really confusing is people are thinking they're paying out of pocket. It's always been this way where they're paying is the credit score, each tier down, is going to be typically a little bit higher unless they want to pay a rate buy down.
So what you're saying is, just correct me if I'm wrong here, but like, it's just their credit score affecting their mortgage rate. So it's not like when they come to the closing table, they don't have to bring extra money in the traditional way, unless you're talking about if they chose to buy down the rate, which is, could you explain that? I'm sorry.
Absolutely. So and from there, there's rate options below what your actual rate option is. It's just going to cost money out of pocket that is paid along with the closing cost at closing. If somebody's really wants to stay at a specific payment per month or lower, it could be a good idea. If they're able to somehow in this crazy market get a seller credit that they're willing to put towards it, great.
Okay.
However, that's not the reality in almost all scenarios right now, as you're aware.
Yeah, the competitive nature of how many offers they're getting, and yeah.
What we're telling clients, well, first off, this has actually been in effect with almost all investors for 2 to 3 months already. Clients were not even aware of it until they saw the news headlines. Yeah. So we didn't receive any complaints from anybody in the industry along the way because they weren't aware. Now it's that shock, thinking I'm now paying a whole bunch of money out of pocket, and somebody with a much lower score is now getting something more favorable and better than I am. That's not necessarily true. What is happening now is, yes, they are paying a little bit more, somebody with that 760 or 740. But I ran a scenario just a couple days ago, earlier this week, and somebody, exact same price loan, exact same down payment, exact same closing cost, somebody with an 800 credit score was priced in the low to mid 6.375 actually. Yeah. And somebody was in the mid 600s and they were quoted at 7.5%. So a little over a 1% difference in rate.
So the 800 score got like 6.5, and then the 7, what was that, 760?
Was that 7.5?
Was that 7.5? So a full point.
Correct.
Okay.
And in some cases, potentially even more, depending on the exact scenario.
Which can be significant. I understand, especially when we're talking about the affordability of like their monthly payment. Is that comparatively to what it was before, because we were at 740 before, was like our limit before it became sort of prime or whatever. What is the percentage of loans have you seen that are actually affected by the small segment that were moved? Is it the majority of the loans? Is it rare? Is it?
I'm going to say somewhere in the middle.
Okay,
we do certainly have a lot of clients that might be in that 740 to 760 range, but not at that 780 or above.
Okay.
I'm not going to say it's a vast majority. I'm not going to say it's a small minority. It's somewhere in the middle. However, I do want to come back to rate buy down for a moment here.
Yeah.
We typically don't recommend it, and the reason we don't, let's hypothetically say you wanted to do so, and you wanted to put $1,000 or $2,000 towards it, and then 6 months from now, we look in our system and we have means of guiding you, doing a couple simple things, and all other things being equal, your score is likely to jump based on our guidance. B, now let's say rates just naturally come back down at some point.
Oh, okay.
Between those two things, 6 or 8 months from now, if we refinance you anyway, and now you get a better rate and you're saving money, but you put $1,000 or $2,000 towards a rate buy down, that $1,000 or $2,000 is now a sunk cost. You're not getting it back now that you refinance the lower rate anyway. So we generally don't recommend it unless there's a firm price per month that you just cannot exceed. Well, that might be a different story.
And have the money to buy it.
Have the money to do
it.
Because usually it's going to take, for what that additional payment per month is going to be for 6 months, a year, a couple of years, it's probably going to take a lot longer to recoup that money you're spending on the rate buy down. But so again, as you suggested earlier, there is certainly some truth to this. It is also certainly being blown out of proportion to a large degree. But if there's any other questions, this is where I love agents such as yourself that want to educate yourself. You can be the trusted advisor. And if it gets deeper than that, we are here for you and your clients along the way.
Absolutely. Yeah, I think for me, the role is to make sure that we tamper down the emotional reaction to the news, and as well as have those resources like yourself to explain what is actually going on in the market and how much it's affecting them.
Yes.
Because very truthfully, I'm sure when we put the numbers like side by side and run scenarios as far as like how much you're paying per month due to this change in policy, yes, it is a change, but I mean, is it affecting your ability to buy in the area and the price point that you want to buy? I would imagine for most people, not dramatically. You know, it is affecting your monthly payment because a lot of people, when I sit down with them, a big thing about affordability is how much can you afford per month. That's obviously directly correlated to their mortgage interest rate. And with the little bump in the policy of changing it from 740 to 780, yes, it has an effect, but is that a detrimental effect that stops them from shopping versus is this something that is part of our planning, is part of our budgeting, is part of our home shopping like narrative for that individual client? So I think for the future, honestly, it's just having these sit-down conversations with you when we get these news articles, you know, and that are intimidating, that may prevent somebody from moving forward and buying their first home or buying their next home. Obviously, having that conversation with an experienced lender is going to be key when it comes to making financial decisions for your family when it comes to home buying. So thank you, Aaron. I really appreciate you sitting down with me today to do this short little video, because I know there's a lot of people out there, including myself, who have read the articles and went, whoa, is this going to dramatically affect myself, as well as is it completely unfair, the structure? So I know myself, along with many other people, are going to have those same questions. And I just want to thank you again for your time today.
You're very welcome. Thanks for inviting me to do this.
Awesome. Thanks again. And guys...